Picture this. You're 34 years old. You earn $78,000 a year. Every single paycheck, without thinking about it, 6% goes straight into your 401k. Your company matches 3%. You've been doing this for 9 years. By every standard measure, you're doing everything right. Your HR department told you to do this. Your financial planning app gives you a green checkmark. Every personal finance article you've ever read says to max out your employer match before anything else. It's rule number 1. It's the advice everyone gives. It's what responsible adults do. Now let me ask you a question that nobody in HR will ever ask you. What if that advice is right for the financial system, but wrong for you specifically? Not wrong in a catastrophic way. Not wrong in a you've been lied to way. Wrong in the way that a map can be technically accurate but still lead you somewhere you didn't intend to go because it was drawn for someone else's destination. My name is Alicia. I spend and have been spending way too much time obsessing over financial data, human psychology, and the hidden mechanisms of wealth so you don't have to. And today I want to have the 401k conversation that your HR orientation, your financial advisor, and every generic personal finance video refuses to have. I'm not here to tell you that 401k's are bad. They are not. I'm here to show you that the advice surrounding them is dangerously incomplete. And that incompleteness is costing millions of people hundreds of thousands of dollars over their lifetime, quietly, invisibly, without anyone ever pointing at it and calling it a problem. So, let's talk about the truth that no one is telling you. Let me start with what is genuinely true about 401k's, because understanding what's right about the standard advice makes it easier to see what it misses. The 401k was created in 1978 as a supplement to pensions. Over the following decades, corporations realized it was cheaper to offer employees a 401k than to fund a guaranteed pension. Pensions disappeared. 401k's became the primary retirement vehicle for most Americans. That shift transferred all investment risk from the employer to you. Today, the conventional wisdom about 401k's goes like this. Contribute at least enough to capture your full employer match. That match is an instant 50 to 100% return on your money. No investment in the world reliably beats it. Your contributions are pre-tax, meaning you reduce your taxable income today and only pay taxes when you withdraw in retirement, presumably at a lower rate. Investment growth compounds tax-deferred for decades, producing significantly more wealth than a taxable account would over the same period. The 2025 contribution limit is $23,500. People over 50 can contribute an additional $7,500 in catch-up contributions. All of this is accurate. All of it is genuinely beneficial. The employer match alone is so valuable that stopping contributions entirely to miss it would be a financial mistake for almost everyone. So when this video says stop contributing, I need you to understand what I actually mean. Stop does not mean zero. It means stop contributing blindly without understanding what you're actually agreeing to. Because there are specific, very real situations where maximizing your 401k contributions beyond the employer match is not the optimal move, and the financial industry has almost no incentive to explain this to you. Let me show you some numbers that fundamentally change how you should think about 401k contributions. The average 401k plan charges total fees between 0.5% and 2% annually. That sounds small. It is not small. A fee of just 1% on a $500,000 balance costs you $5,000 every single year. Over 30 years, that same 1% fee reduces your final balance by approximately 28%, and the average 401k charges nearly 0.9% more per year than a simple index fund you could open yourself in an hour. Let me put that in dollar terms. Someone who invests $500 monthly for 30 years in an index fund charging 0.05% will retire with approximately $680,000. The exact same contributions in a 401k charging 1% in total fees produces approximately $490,000. That 0.95% fee difference costs $190,000 over a career, not because of bad investing, because of administrative costs that most people never read about. Your 401k plan's fee structure is disclosed in documents called summary plan descriptions and fund prospectuses. Almost nobody reads them. The financial industry counts on that. The core logic of a traditional 401k is that you pay taxes later when you're in a lower tax bracket in retirement. This assumption was built for a 1980s economy. Here's the problem. Tax rates in the United States are currently near historic lows. The national debt is over $35 trillion and growing. Most credible economists agree that tax rates will likely be higher in the future, not lower. If that's true, deferring taxes is not always a benefit. For certain income levels and life circumstances, it could mean deferring taxes into a higher rate environment. And it gets worse. The government forces you to withdraw money from your 401k starting at age 73, whether you need the income or not. These are called required minimum distributions. For people who've saved aggressively, these forced withdrawals can push them into tax brackets higher than the ones they were in during their working years. The very strategy designed to reduce your tax burden can, without proper planning, increase it. Money in a 401k is not your money in any practical sense until you reach 59 and a half. Before that age, withdrawals are subject to income tax plus a 10% early withdrawal penalty. Here's what that means in human terms. A 38-year-old who loses their job and has $45,000 in their 401k, but no emergency fund faces a genuine crisis. They can access that $45,000, but after the penalty and taxes, they might receive $28,000. They sacrifice $17,000 in penalties and taxes because the system encouraged them to prioritize retirement savings over liquidity. Approximately 40% of Americans withdraw from their retirement accounts early, not because they want to, but because they have no other option. A fully funded emergency fund is worth more than additional 401k contributions beyond the match if you don't have one. This is not a controversial statement among financial researchers. It is simply not what financial institutions teach. Now let me tell you what the financial industry, your HR department, and most generic personal finance content systematically fails to communicate. Capturing your full employer match is as close to a financial law as anything in personal finance. A 3% match on a $70,000 salary is $2,100 in free money annually. Nothing else you can do with that percentage of income approaches that return. But beyond the match, everything becomes situational. And the advice you receive almost never acknowledges the situation you're actually in. Consider someone earning $65,000 who carries $18,000 in credit card debt at 22% interest. Their company offers a 3% 401k match. The standard advice: contribute enough to get the full match, then put extra money toward debt. The math reality: after capturing the match, every additional dollar going into a 401k, earning a projected 8% annually, is competing against debt costing 22% annually. The 401k contribution beyond the match is mathematically inferior to debt elimination. Paying off 22% interest debt is a guaranteed 22% return. No 401k investment reliably matches that. The system never explains this trade-off clearly because it has no incentive to. If your employer offers a Roth 401k option and you are under 40 and you believe your tax rate will be equal or higher in retirement, which is the likely scenario for most working Americans, then contributing to a Roth 401k instead of a traditional 401k is almost certainly the superior choice. Roth contributions are made with after-tax dollars. Growth is tax-free. Withdrawals in retirement are tax-free. Require minimum distributions do not apply to Roth accounts. The question your HR orientation almost never asks you is, what do you think tax rates will look like when you retire? Your answer to that question should determine which account type you use. The generic advice ignores it entirely. Same contribution, same employer, potentially $200,000 more at retirement just by checking a different box on your enrollment form. Your 401k does not give you access to every investment. It gives you access to a curated menu of funds selected by your employer's plan administrator. That menu is often limited, and the available funds are frequently more expensive than what you could access in an IRA or taxable brokerage account. A total stock market index fund at Fidelity or Vanguard might charge 0.03% annually. The equivalent fund inside your 401k plan might charge 0.5% or more, simply because it's the only option available to you. After capturing the employer match, maxing a Roth IRA, which offers broader fund selection and typically lower fees, is often the better second step before returning to additional 401k contributions. Here is a scenario that blindsides retirees who followed all the standard advice perfectly. You retire at 65. You receive Social Security of $2,100 monthly, $25,200 annually. You begin required minimum distributions from your 401k. At 73, your RMD is $18,000. Your combined income is now $43,200 annually. At that income level, up to 85% of your Social Security becomes taxable. The 401k distributions that were supposed to come out at a lower tax rate in retirement are now triggering taxes on income you assumed was separate. The interaction between 401k, RMDs, and Social Security taxation is one of the least discussed and most financially painful surprises in retirement. It is entirely avoidable with advanced planning, but only if someone tells you about it. So if the standard advice is incomplete, what does the complete picture look like? Here is the order of operations that financial researchers broadly agree produces the best outcomes, and that almost nobody teaches in this sequence. Step 1. Capture the full employer match in your 401k. This is non-negotiable. It is free money. A 3% match on a $70,000 salary is $2,100 per year. Take it every time, without exception. Step 2. Build a 3 to 6 month emergency fund in a high-yield savings account before contributing beyond the match. Liquidity protects you from becoming one of the 40% who raids their retirement account during a crisis and pays a penalty for it. Step 3. Eliminate all high-interest debt. Anything above 7 to 8% interest rate. Guarantee 15 to 22% returns from debt elimination beats speculative investment returns every single time. This is math, not opinion. Step 4. Max your Roth IRA. The 2025 limit is $7,000 or $8,000 if you're 50 or older. Lower fees, broader investment selection, tax-free growth, no require minimum selection, tax-free growth, no require minimum distributions. For most people under 50, this beats additional traditional 401k contributions dollar for dollar. Step 5. Return to your 401k and increase contributions. Now that you have liquidity, no high-interest debt, and your Roth is maxed, additional 401k contributions make real sense, especially if you're in a high current tax bracket where the pre-tax deduction genuinely helps. Step 6. Consider a taxable brokerage account for anything beyond 401k limits. No contribution limits, no withdrawal restrictions, full flexibility. Not tax advantage, but the freedom that comes with it has real value that most retirement advice ignores. This sequence optimizes for fees, tax diversification, liquidity, and long-term flexibility. The standard advice optimizes for one thing: getting money into a 401k. Those are not the same goal. I want to be absolutely clear about what this framework does not say. It does not say avoid 401k cess. It does not say traditional 401k-s are a scam. It does not say ignore your employer match. It says that the conversation about where your next retirement dollar goes after you've captured the match deserves far more nuance than the financial industry offers you, and that nuance is worth hundreds of thousands of dollars over a lifetime. Let me describe 5 specific profiles of people who should seriously reconsider their current 401k contribution strategy. Not all of them should stop contributing entirely, but all of them should stop contributing without thinking. You are contributing 10 to your 401k, but have less than 1 month of expenses in liquid savings. You are 1 car repair or medical bill away from either going into credit card debt at 22% or early withdrawing your retirement savings at a 10% penalty plus taxes. Reduce your 401k contribution to the match minimum. Build your emergency fund. Then return and increase contributions. You are maxing your 401k while carrying $12,000 in credit card debt at 19% interest. The math is unambiguous. You are earning an expected 8% in your 401k and paying 19% on debt simultaneously. Capture the match. Use the remaining contribution dollars to eliminate the debt. The guaranteed return on debt payoff outperforms the extra 401k contribution every single time. You are 29, earning $140,000 and contributing to a traditional 401k because that is what everyone does. You live in California or New York. Your marginal rate today is around 37% federal plus state. In retirement with modest withdrawals, your effective rate could be similar, or higher. You are potentially deferring taxes into a worse environment. Roth options deserve serious analysis at your income level and age. You have examined your plan documents, and your total expense ratio across available funds is over 1.5%. After capturing the match, every additional contribution is trapped in an expensive fund menu. Contribute to get the match. Then open a Roth IRA with Fidelity or Vanguard. The fee difference alone justifies redirecting your next dollar there. You are 52, have $480,000 in a traditional 401k, and are adding more every year. You have done almost no Roth conversions and have no Roth balance. Your required minimum distributions starting at 73 will be substantial. Adding more pre-tax money to an already large pre-tax account may not be the optimal move. A financial planner who specializes in Roth conversion strategy deserves a conversation before you contribute another dollar on autopilot. Remember the 34-year-old I described at the beginning? 9 years of automatic contributions, green check marks everywhere, doing everything right. Here's what I didn't tell you about her. She has $6,800 in credit card debt at 21% interest. She has 2 months of expenses and savings. Her 401k plan charges 1.1% in total fees. She has never heard of a Roth IRA. She has been contributing 8% to a traditional 401k because someone told her to, and she never had a reason to question it. She is not making catastrophic mistakes. She is making the mistake of following generic advice in a specific situation, and over 30 years, that costs her roughly $280,000. Not because she did anything wrong, because no one asked her the right questions. The financial industry profits from simplicity. Simple rules are easier to market and easier to follow, but your financial life is not simple, and you deserve advice that treats it that way. So here is what I want you to do this week. 1. Pull up your 401k plan documents and find your total expense ratio. If it's above Benzer 0.5%, you need a strategy. 2. Check whether your employer offers a Roth 401k option. If yes, and you're under 40, research whether switching makes more sense for your situation. 3. Write down your non-mortgage debt balances and interest rates. If anything is above 8%, that deserves prioritization over additional 401. Contributions beyond the match. 4. Check your emergency fund. 1 month of expenses means you are one crisis away from derailing years of savings. That matters more than an extra percentage point in your 401k. None of this is about undoing years of contributions. It's about making the next dollar you save work as hard as possible for your specific situation, not for the average person the financial industry designed its advice around. The 401 Slay tool, it is a good tool, but no tool works correctly when you use it without reading the instructions. You just read the instructions. If this video made you think differently about something you've been doing on autopilot, that's exactly what I'm here for. Subscribe if you want more conversations like this one. And if you know someone who has been contributing blindly without ever being asked these questions, share this with them. The gap between what the financial industry teaches and what actually works for real people is the gap I'm trying to close. One video at a time. I'll see you in the next one.